You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. He's speaking to us from Gulf Shores, Alabama. Welcome back to the show.
Jim, thanks for having me.
The Fed cut interest rates 0.25% after so much pressure from the president to do so. And then afterwards, I'm not hearing anything. I'm not hearing anybody commenting about it being good, being bad, being needed, not needed. Tim, what's your take on this rate cut? Which, by the way, you said there would be certain markers that predicted the exact time this would happen.
Yeah, I think 2 or 3, maybe a couple of interviews ago, I don't remember the date, but a couple of interviews ago, I said pretty boldly, I said, write it down. So somebody write it down. They're not going to cut until the spread differential between the discount rate and the 3-month T-bill drop back below 50 basis points. And as of the close on Wednesday, it was at 52.52. So that prompted the cut. With that said, let me explain. This is, and I'm not defending anyone, so I don't want anybody to take this, out of context. But it's just an observation. It's just stating the facts. But this rate cutting cycle, this entire rate cutting cycle that began last September, has been, contrary to what people believe, the most aggressive rate cutting cycle in history. And when I say in history, I mean I have data going back into the 50s. So within that context, we had an extremely long plateau period. What I call plateau period, where rates went through the rate hiking cycle, and then we hit our peak with rates, with the discount rate setting at 5.5, and it just plateaued forever. And it was one of the longest. It wasn't the longest, but it was one of the longest plateau periods. And again, I'm not defending Powell. I don't care. I don't have a dog in that hunt. I want to be clear. I don't care. I'm just stating the facts here. But, he was criticized for not having cut sooner. Well, in reality, when I look at this model, it didn't prompt a cut, because that differential, that spread differential, had not widened significantly, where the 3-month had dropped below the discount rate. It had not broadened enough to where it prompted a cut. And so that's why we had the long plateau period. And so people were saying, it was in the news, I remember it vividly, everybody was saying, oh, Fed, he's behind the 8 ball. He's behind the 8 ball. He should have already cut. No, he shouldn't have. And people point to they point to the inflation data, and they point to the unemployment data and the employment data. That's all nonsense. None of that matters. And this rate cutting cycle should prove that if someone looks at the data. But as soon as we dropped out of that plateau period and the 3-month T-bill started to decline and that spread widened, I don't remember exactly the number, but this rate cutting cycle has, we've seen somewhere a spread between like 0.7 and 0.5 has been sufficient to prompt these cuts. If you go back in history, let me digress for a minute. If you go back in history, in the post-09, well, let's do it this way. In the pre-09 world, that spread would run between 1 and 2 points. In other words, after you got to the plateau period of a rate hiking cycle, the T-bill would have to drop somewhere between 1 and 2 points below the discount rate before it would prompt a cut by the Fed. Fast forward to the post-09 period, and that spread it narrowed to less than a point, somewhere around 0.9 to 0.7, somewhere along there. So it narrows. Then we get to the current rate cutting cycle, and it's narrowed even more. That spread has been between like 0.7 and 0.5. So it's tightened even more. So in reality, contrary to what the masses think, which is pretty much where the truth always lies, this has been the most aggressive rate cutting cycle, in spite of the fact that we had the longest plateau period, and in spite of the fact that we had this rather extended pause period. That's another phenomenon. After a rate cutting cycle begins, there's typically always, at least with the last 3 rate cutting cycles, there's been a pretty pronounced pause period in which, you get the rate cuts, then everybody says, oh, everything's okay, and rates plateau, market rallies, everything's groovy, and then you eventually break down out of that pause period, and the resumption of the rate cutting cycle begins. And so we've been in that pause period all year. Back in August, we started trying to break down out of that pause period. We have since done so, and again, with the broadening of that spread, bingo, right on time, they cut. And so, anyway, I just wanted to explain this rate cutting cycle. In spite of, I find myself, like I said, I'm not defending Powell. I'm just saying, in spite of the criticism that he's been late, in reality, this has been, again, the most aggressive rate cutting cycle going back into the 50s.
So would cutting rates do things like lower your mortgage rate or drop the interest rate on your credit card?
Well, I don't know about the credit cards, but, all of the rates, one by one, the maturities, it started with the 3-month. The 1 month was a little bit of an oddity. It held out a little bit, but slowly, that pause period I talked about, I watched it. The 3-month broke, and the 6-month, then the 6-month broke, and then like the 1 year, the 3 year, the 5, it finally broke down. Then the 7, I think the 7 year broke down like maybe last week or a week before last. I forget now. I've been watching them. The 10 hasn't broken, but yeah, it's all of the other maturities, the further out maturities, they follow, and so yes, this should. As this rate cutting cycle continues, and it will continue, it should have an effect on the longer term rates, which should have an effect on mortgage rates. Yes,
but that's still some time down the road.
Well, the rate cutting cycle. Here's another thing I want to. Yes, I mean it's coming. We're in the. I mean it's happening. I should say. Let me point out something else. When we were, this is funny to watch when you're aware, but when we were, let's back up to that plateau period, back before the first rate cut began. Powell was tough. He spoke tough, hawkish, as they say. And, isn't that the term they use? Yeah, hawkish. He was tough guy. He wasn't going to cut, and the market bought that. The market, so rates, they remained, like I said, that spread remained very tight, and went on for one of the longest pause periods ever. And then finally, as rates start to decline, he turns dovish. He's like, he becomes more accommodative, and that's because they are painting the appearance of control when there's not control. I mean, he's following the market. He's following the T-bill, but he's presenting this element of control or perceived illusion of control that's not there. And he just changes his stance. And so we saw those cuts that led us into last December when the plateau period or this pause period started, and he was once again tough. We're not cutting. We had this hawkish stance. But then, right last August, this late August, mid to late August, as we started breaking down out of this pause period, they were at Jackson Hole, and his stance changes. He turns dovish, like he's accommodative. Well, they know that this rate cutting cycle is resuming now, and I didn't listen to the speech. I just saw it in a headline. But now he's saying at least 2 more cuts this year. So he's being accommodative. Well, why? Because he's a nice guy, or because the rate cutting cycle has resumed and they're painting the illusion of control? And I think it's obviously looking at it from my vantage point, it's obviously the latter. So anyway, I don't know if that answers your question, but yes, lower rates are coming, and it's a result of the resumption of the rate cutting cycle. And bottom line.
We'll have more with Tim Cyclesman Wood right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, September, October, usually the most nervous time on the stock markets. That's usually when major corrections are made. Is there any indication that we're in for a major correction this fall?
Well, yes and no. Yes, for other reasons besides just the fact that we're in the fall. But beside that point, yes, we've seen a very, very extended intermediate term advance out of the April low. I mean, it's I'm not minimizing that advance. It's been one heck of an advance for sure. In fact, I did not think that advance would better the previous high, but it has. But nonetheless, it's stretched, and there are some cycles due in here, and we've seen this rate cut. And this rate cut, people think that the rate cuts are good, but if we go back and look at some other history, let's just look at the recent 20 years. Back in January, it was March of 2000, but in January of 2000, the industrials peaked, and the rate hiking cycle resumed into I think it was like May or so of 2000 was the last rate hike. And as the market plateaued there, using that word again, rates began to turn down as we moved into 2001. 2001. And as that rate cutting cycle, in spite of the fact that they began to cut rates, there were some counter trend rallies, but the decline into the 4-year cycle low following that January top, it resumed. In other words, the rate cuts did not halt the decline. And then looking forward to the 2007 top, well, they began cutting that time just prior to the 2007 top, but nonetheless, the market had moved into that 4-year top once the structure was in place, the rate cutting cycle. It did not halt that decline either. It just the market did its thing. And, they'll point to, hey, that the cutting rates is, because everything is a spin, right? Everything is a false, I don't know how to say it. It's a spin. So, they try to sell the public that, we're cutting rates. And so that's somehow preventing the decline, but the market continued to decline into the 2009 low, which was, I remind everybody, was dubbed the worst financial crisis since the Great Depression. You look forward, coming on to the 2020 top. At that top, they had already begun the rate cutting cycle there. The market declined, and the rate cuts arguably did nothing. They coincided with the decline all the way down, and they kept rates virtually at zero, is at a quarter point for nearly 2 years. And then we get into this more recent out of the 2022 low in the advance of the upturn of rates, and into the plateau period that finally followed. And now here we are once again, rate cuts, and this is happening right as we should be. The market should be moving into this 4-year cycle top. So yes, the answer to your question is not because of it being September and October time frame, but because it just coincidentally this time frame is lining up with the resumption of this rate cutting cycle and what should be some longer term tops in the market. Now, that said, I don't have structure at this moment to say yes, we've seen that top. That's something I'm covering in the obviously in the letter and my short term updates, and we'll be putting that out for subscribers as it develops. But yes, the rate cuts, I think, are, as far as it relates to the market, I don't think that's necessarily a positive thing at all.
Is gold still going to be a safe haven if we have a correction? We hit record highs in the precious metal, it seems, every week.
I know. This has been. It's just like stocks. It's the same story, Jim. Gold has been. The performance there has been outstanding, but again, I think that it's the part of the everything bubble, in my opinion. And gold has performed well because of the inflationary pressures. The expansion of debt out of going back as far as the '02 low, and that has continued with every downturn. Coming out of the '09 low, out of the 2020 low, we've seen that continued expansion of debt, and the overhanging. Whatever you want to call it, 900-pound gorilla in the room is the deflationary cloud that the Fed has been fighting for the last 25 years. And if we turn down, or when we turn down out of this 6 long-term economic cycle and this everything bubble, then I think I'm going to stick to the story. I'm not denying gold's performance here. It's been one hell of a performance. But when this thing turns, I think gold and pretty much all asset classes are going to go with it.
What's the story on crude oil?
The same. Crude oil has been obviously much weaker relatively, or structurally, or however you want to say it, relative to gold. But I think crude oil has, we should have a 3-year cycle top in place. Well, I know we have a 3-year cycle top in place. And since then, the bounces, I've been saying in the short-term updates and newsletters that the bounces are counter-trend, and they have been, and the story remains the same. I think we have a higher degree top in crude oil, and I think that the fact that crude oil has remained soft relative to gold is telling us, or it's reflective, I should say, of those underlying deflationary forces that are trying to take hold.
Tim, what's your view on inflation? The government keeps telling us, inflation has come down. It's not rampant anymore. But I take a look. Well, I don't personally, but my wife takes a look at the grocery bill and says, this costs 3 times as much as it did 2 years ago. How can they say that prices are coming down?
They can't. Anybody that believes anything comes out of a government statistic or their mouth, they're crazy. I mean, you can't believe anything that you're told anymore. The inflation, like I said, I don't know how to explain it. It's a tough concept to get your mind around, but it is the system. Let me back up. Richard Russell was a well-known market analyst, Dow theory guy, through the 50s, 60s, and 70s, 80s. I mean, he kind of got started in the 50s, but he became very popular in the 70s and 80s, and into the through the early 2000s. But anyway, he had a saying he coined, and he said, "Inflate or die, inflate or die." And I don't know if he really understood. Maybe he did. The significance of that saying, because like we talked about before, I mean, we live in a debt-based, fiat debt-based system, and it has to have that inflation, the debt expansion and inflation to survive. And that's what we have seen, particularly coming out of the COVID low. It should be obvious to everyone, is the generation of inflation to keep the system going. And so, yes, we've obviously had inflation. That's why gold has done as well as gold has. It's been a hedge against that inflation. But again, the overhanging boogeyman. Why are they doing this? Why are they having to reinflate? Why the debt expansion? Why? Ask the question why. And the answer to that is that this debt expansion has occurred, and the creation thereby of this inflation has occurred because they are fighting the deflation. And once that battle is lost and they can no longer, generate the needed inflation and debt expansion to keep the thing going, the overhanging deflation is going to take hold, and this inflation that we're seeing is going to turn to deflation. Now, that may not be true And, with food prices and certain items because of the scarcity and the impact that that's going to have. But it's by and large all this inflation this inflation we've seen in asset prices, that's going to change. And I think it's going to take, housing, gold, the cryptos, equity markets. I think everything is at risk there. Everything. Because it is truly the everything bubble. And it's a function of this, of the debt to keep the system alive.
Tim, thank you so much for chatting with us.
Thank you for having me.
Our guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. If you have any questions for Tim or for any of our guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on X @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.